global standards, island agility, and Caribbean unity. We are the CDFA. Good afternoon, everybody. We have a packed 90 minutes today. I would encourage you all, if you are comfortable, to turn on your cameras. We're building a community here, and I really think it helps both the panelists and your colleagues to be able to see who you are. I often say that finance is one of those things where the currency is, well, aside from just currency, it's also trust, and familiarity helps with that. So if you are comfortable with that, turn it on. It helps with the human connections. If you have questions throughout, and I say everybody to remain on mute for the most part, if you have questions, please drop them in the chat throughout the session. My colleague at the CDFA Executive Committee, Ms. Melissa Bouta, will be monitoring the chat, and she'll pose the most relevant questions to the panel in the Q&A session, or if she feels that it's probative at the moment in context during our conversation. We might not get to all of the questions, but I'd encourage you to reach out to us at cdfa@caribbeandigitalfinance.org with your inquiries. There'll be a slide at the end where you can be reminded of that, so you don't have to write that down right now, or Melissa can put it in the chat as well. I'm Dennis Augustine. I am a member of the Executive Committee at the Caribbean Digital Finance Alliance, the CDFA. We were formed under the auspices of the UNCDF, the United Nations Capital Development Fund, to be part of the glue that moves finance together in the region. And by the sorts of people that we have here on this call today, I think that we're starting to achieve some of that purpose. Before we start, a quick note on tone. I know that the last decade has been tough. Regulators have felt pressure. Banks have felt pressure, citizens have felt excluded, but we're not here to blame anyone for the past. What we're here to do is to take advantage of the change in the rules that allow us to now build a solution together. And so with that, I'm going to invite, all right, now to kick us off, we need to understand the big picture. It's not just about banking rules, it's about development of our entire region. And to set the broad context, I'm going to invite Ms. Kim Osborne, the Executive Secretary for Integral Development of the Organization of American States, to deliver some opening remarks. Kim, I want to thank you for joining us. You have about 3 minutes to set the stage and provide your remarks.
Thank you so very much. Distinguished ambassadors and permanent representatives to the OAS, permanent secretaries, esteemed regulators and policymakers, leaders and officials from the public and private sector, partners and colleagues, good afternoon, and a very hearty welcome to all of you for joining us this afternoon. It is a pleasure to open this important regional dialogue on leveraging the FATF financial inclusion guidance to expand Caribbean digital finance ecosystem. On behalf of the Organization of American States, particularly the Secretariat for Integral Development, which I have the great honor to lead, I extend my sincere appreciation to all of you for your participation, particularly all partners at the Caribbean Digital Finance Alliance for their close collaboration in making today's exchange possible. I want to especially recognize our presenters, Annie Bertrand from the Caribbean Digital Finance Alliance, Ladisa James Williams from CIBC, Alison McIntyre from the Caribbean Financial Action Task Force, and our moderator, Dennis Augustine from DX Alliance. Our thanks to each of you for taking the time to be with us today. Today's webinar is part of the Secretariat for Integral Development, the development pillar of the OAS, broader capacity building efforts on fintech and digital transformation in the Caribbean, within the framework of our MSME Work Plan 2024-2027. It reflects our shared conviction that financial inclusion is not simply a social objective. It is an economic imperative for resilience, competitiveness, and sustainable development in the Caribbean. The contribution of micro, small, and medium-sized enterprises to the economies of Caribbean member states is well documented. They generate employment, drive innovation, sustain families, and anchor our local value chains. Yet we know that access to finance, digital tools, and secure financial services remains uneven, particularly for women-led and women-owned businesses and small enterprises operating outside major commercial centers. Bridging this gap is central to the OAS's development agenda, and it is precisely where digital finance and proportional regulatory approaches can become powerful enablers. Through the Secretariat's MSME and digital transformation programs, more than 10,000 MSMEs and entrepreneurs across the region have benefited directly from training in financial literacy, access to finance, business formalization, and digital tools. Over 350 officials from our national MSME authorities have strengthened their digital literacy through the train-the-trainer models, while hundreds of enterprises have been equipped along the full digital value chain from product development and e-commerce to logistics and customer management. In the Caribbean specifically, our work with governments and the private sector has helped advance policy dialogue on fintech to improve the enabling environment and promote financial technologies as tools for inclusion, efficiency, and transparency. From customized digital transformation programs to partnerships with global technology platforms to the development of fintech policy guidance for the Eastern Caribbean, the Secretariat has remained committed to ensuring that digital innovation translates into real opportunities for Caribbean entrepreneurs. Today's webinar brings together an exceptional group of regional leaders and technical experts, including the Caribbean Association of Banks and the Caribbean Financial Action Task Force, to examine how the latest Financial Action Task Force, the FATF Financial Inclusion Guidance, can be operationalized in a way that strengthens both financial integrity and economic participation. We firmly believe here at the OAS that financial inclusion, digital transformation, and MSME development must advance together. Regulatory modernization, technological innovation, and institutional capacity building cannot move in isolation. They must be synchronized so that innovation is safe, access is meaningful, and growth is inclusive. This is why today's discussion is not only timely, but also strategic. It speaks directly to how the Caribbean can leverage global regulatory evolution to unlock local economic opportunity, strengthen trust in the financial system, and ensure that digital finance becomes a tool for formalization, resilience, and competitiveness, rather than a source of new divides. Before closing, I would like to extend special thanks to our keynote speakers again and our panelists, to all the permanent missions who are joining us here in Washington. Thank you for taking the time this afternoon to be with us. You know of our work, of the thrust and the effort that we've been making to work with our MSMEs in the Caribbean. Thank you to the MSMEs who are present and others who are joining us for this important dialogue. We hope that this is not the conclusion, but part of our continued work with you towards ensuring MSME competitiveness. Again, I would like to emphasize that the Caribbean's digital finance ecosystem is not only built on technology, it is built on policy coherence, institutional trust, and regional cooperation. And it is through forums such as this that we can convert guidance into action, dialogue into implementation, and innovation into opportunity. Thank you again for your participation, and I look forward to a productive and engaging discussion. Thank you.
Secretary Osborne, thank you so much for those opening remarks. I could not have said it better. The power of policy to effect change is one of the most important tools that we have in our tool chest. We can do so much with the stroke of a pen, and through as well that collaboration and building of trust. So with that, we now want to understand the rules that have actually changed how to allow us to do inclusion. To walk us through the new FATF guidance is Ms. Annie Bertrand, financial inclusion expert and co-founder of the CDFA. Annie, you have these 25 minutes to demystify this de-risking paradox for us and to explain the new rules.
Thanks, Dennis. Thank you very much. And thank you, Ms. Osborne, Secretary Osborne, for your kind welcome opening remarks. This is highly appreciated to see that we can count on our development organizations to support the efforts that we're doing. Good afternoon, everyone. Today, I will talk about the imperative of financial inclusion for development and compliance. Over the past 20 years, living and working for different organizations to foster inclusive economic growth in the region, I became frustrated because no matter how much millions of dollars we had in grant funding or technical assistance, the MSMEs were really unable to grow significantly because they lacked access to digital financial services. So in my last projects with the OAS and UNCDF and the World Bank, I worked really closely with financial regulators and financial institutions to address this problem. But since FATF now issued this new financial inclusion guidance in June of this year, this problem is no longer mine alone. It's also yours, especially you, the country with financial regulators in this room and financial institutions, because financial inclusion now is essential to achieve FATF objectives. So now, moving on, I just wanted to, Okay, so the business case. So today in my presentation, I want to share some of my research findings to build a business case for financial inclusion, and I will explain the financial exclusion problem, its root causes, and suggest some solutions in alignment with the new financial inclusion guidance. And finally, I will present the key highlights of the FATF guidance. And hopefully by the end of today, you will also feel compelled to address this problem. So first, let's start on the same page. So what is financial inclusion? The new FATF definition is loaded. So let's unpack it. It is defined as follows. So the access to and usage of an adequate suite of appropriate, safe, convenient, and affordable financial services and products by both individuals and entities that would benefit from such services. So many people think that financial inclusion is the percentage of individuals who have an account in a financial institution like a bank or credit union. But that's not it. Financial inclusion is about usage of adequate financial services for both individuals and entities. And by entities, we mean nonprofit organizations, including charities, and for-profit organizations, which includes, of course, our micro, small, and medium enterprises. Now, essentially, the concept of financial inclusion has evolved for the purpose of financial resilience and well-being in society. And to achieve these objectives, countries and financial institutions must ensure that products and services are properly designed for all segments of society. So they must essentially be adequate, appropriate, affordable, convenient, and safe. So that's essentially the mouthful of definition of financial inclusion. So why should we care about it? So before the pandemic, the Caribbean, the Caribbean experienced 7 years of consecutive growth in tourism arrival. So essentially, we had 50 million visitors, which represents about 10 times our population. But unfortunately, SMEs are not necessarily able to benefit from that huge lucrative market. So we found with consumer research in the American market targeting these American visitors that we actually leave money on the table. Visitors are willing to pay a lot more for products and services that can be offered by our MSMEs. But visitors do not like to carry cash around. And same thing with the cruise ship industry. Studies have found that 70% of the price that visitors pay for local excursions actually goes to the cruise line. So that explains a little bit the issue. And in terms of global e-sales, they have surged globally tremendously, but not necessarily in the Caribbean. Only 18% of URLs were actually transactional in 2022. So what happened essentially is that we had experienced 4 decades of declining economic growth in the Caribbean because MSMEs are unable to participate in the digital economy. So who are we talking about when we say MSMEs? Essentially, anyone who doesn't work for an entity but generates some level of revenues is an MSME. So together, they represent a large market for financial institutions, and they can generate a lot more economic growth in the region. But to integrate the digital economy, MSMEs need access to digital payment tools, both online and in person. And unfortunately, about 80% of MSMEs do not use digital payments to process transactions. In fact, in the CCU, 80 to 90% of transactions were conducted in cash in 2020. And also, about 75% of MSMEs do not have access to a business bank account. So what do? They essentially operate their business with a personal account. And when MSME mix personal with business expenses, it's very difficult to manage financial records and establish the evidence that banks need to allocate credit. Oftentimes, also, individuals have an account with a credit union. Credit unions are great for financial inclusion, but the problem is a lot of them are not integrated into the national financial infrastructure, meaning that accounts-to-accounts transactions cannot take place through the ACH. Sometimes they're not even integrated to the ATM network. And finally, for about 40% of adults are excluded entirely from the financial system. And among those that are included, about half of them, depending, this is as estimates based on financial inclusion research, but there's a wide variation by country. But about half of the financially included individuals in the Caribbean have an account in a credit union. Now, to accept digital payments, MSME need different financial accounts. So for credit debit card payments using Visa, MasterCard rails, they need a business account and a merchant account. And that is true regardless of the payment tools they are using. So if they just conduct business on WhatsApp, for example, they still need a merchant account to access the payment button. Now, for account-to-account payment using the national payment infrastructure, they need a bank account only because most Caribbean countries have not yet integrated credit unions. So a credit union oftentimes would not allow account-to-account processing. But this is actually the most cost-effective payment method, but it's not useful to access the tourism market, unfortunately. And finally, for mobile wallet account, there is no need for a bank account because fintech can process the KYC directly. It offers lower costs than credit card payments, and it can also be useful for leveraging community agents to build trust and financial literacy. And it can also be used for cross-selling different products, financial products and services. In fact, in many countries in Africa and Asia, mobile wallets are used to provide all kinds of financial services embedded into the wallet. But to me, what's most exciting about these mobile wallets is that we can use mobile wallets to access the tourism market, which is a huge in the region. And the best example might be in Solomon Islands, where we actually have the telecommunication company launched a mobile wallet, and within 9 months, they had used community agents. So these are individuals across the different islands that were trusted in the community, and they opened 25,000 mobile wallets within 9 months. And what's interesting is that visitors can simply open a mobile wallet, load the mobile wallet with their credit cards, and then they can start spending whenever they go visit all these small islands across the country. So it is very powerful. Now, why do MSMEs lack access to these digital payments? So there are 4 root causes of the problem, and I'm going to share brief information on each and suggest solutions that are aligned with the financial inclusion guidance. So first of all, in the Caribbean, the requirements to open bank accounts are overly stringent, especially for business bank account. So during the workshop with banks that facilitated through different projects, many explained that these requirements are not really a big deal, right? This is what oftentimes bank managers may say, that, for example, if someone doesn't have a formal proof of address, all they need to do is to get a letter from their partner or their parent to testify in the letter that they live with them. See, no big deal. But in practice, what we found is that this can lead to extortion, to abuse for many vulnerable individuals. And if someone is essentially fearful to ask this letter to somebody where they live with, which is oftentimes the case, it creates a barrier that prevents access. Now, in terms of the letter of employment, which is oftentimes a requirement for opening a business account as well, we know that entrepreneurs do not have a letter of employment. So banks, thankfully, allows entrepreneurs to write their own letter of employment, testifying that they employed themselves. But when I delivered workshops with with entrepreneurs, especially women entrepreneurs in the Caribbean, nobody knows about this. So again, we found that this ambiguity about the number and types of documents that are needed to open a business account often lead to condescending treatments from customer service. And again, you may say, no big deal, just accept it. But actually, entrepreneurship is the hardest thing to do. So why do we need to create these additional concerns for these small entrepreneurs? The point is that these enhanced measures, these barriers are not necessary and can be removed. And this is precisely what the FATF standards is trying to do. And the last point here I just wanted to make is that I wonder how much money it costs for banks to have all these documents verified, uploaded, recorded for each customer. Oftentimes, the customer service agent must get the supervision approval, the supervisor's approval to make sure these documents are properly collected and documented, etc. So this is a lot of waste in a sense. Now, that leads to the second root cause, which is MSMEs are unable to acquire or maintain digital payment solutions, either because they're not accessible in their country or because they're too expensive. So international e-commerce platforms such as Etsy, for example, where you can sell arts and craft, well, not arts and craft, but businesses that are custom made, do not have a payment integration to Caribbean banks in most countries. Actually, I don't think in any countries. And even PayPal and Stripe are not readily available across the region. So now, to access a payment gateway, what the MSMEs need to do is to have a merchant account to be able to integrate this payment gateway into their website. But again, MSMEs in the region needs a business account in order to have access to a merchant account, which is very difficult to obtain and also oftentimes long waiting time. And then finally, the high cost. The POS device, everybody knows that they're extremely expensive in the region. There are maintenance fees associated to them. So when the MSMEs operate in a seasonal demand region, it's very difficult to justify the cost. But thankfully, the situation is improving. The MPOS is essentially just an application on a mobile phone. So street vendors can actually use it, just download the application on their phone and use it to start collecting payments. QR codes are also a lot cheaper. And we also have some Caribbean online marketplaces that are trying to act as an intermediary to collect payments on behalf of underbanked. So the intermediary can actually process credit card payments, get the merchant account, and then when the payment is being made, that intermediary can transfer the money directly to the account of underserved. But banks, from my understanding, have been somehow reluctant to provide the right merchant accounts to these online marketplaces in many occasions. And finally, we have mobile wallets for payments between businesses and government. That provides huge opportunity, but that brings us to the third root cause, which is that mobile wallet providers, which are called the e-money issuers, lack the legitimacy in most Caribbean countries and opportunity to deploy their digital wallets. So first of all, mobile wallets require a regulatory framework to operate, which is slightly different than the standard payment service providers framework, because EMEs take customer funds, and so therefore they requires a different regulatory framework. But that is changing. Many countries in the Caribbean have started to adopt a new payment legislation that include the EMI framework. Also, they need also in the Caribbean region, we have limited economies of scale, but that again is changing. So we have one regulator in the ACCU that is providing licenses for 8 countries. Instant payment system also represents a great opportunity because it allows all kinds of fintech and e-money issuers to integrate the national financial infrastructure. So it's extremely powerful to increase economies of scale, which allows the reduction of costs for end users. And then finally, which is important, the fintechs struggle to open an account with a financial institution. So with financial institutions, banks. So I know 3 e-money issuers in the Caribbean that actually failed, mostly because they were not able to open a financial account in a bank. And this problem is not unique to the Caribbean, however. So other countries have made change. And now in some countries, like the UK, like Brazil, like Lithuania, they allow e-money issuers to open an account directly with the central bank. Moving on to the last issue here, the low domestic demand for digital payments, given limited value proposition for consumer adoption, essentially, end consumers will not change unless it makes sense for them. So what we need is more investment in digital infrastructure to ensure interoperability and reduce cost. We need to offer complementary financial products, so it's more interesting for them to start using a mobile wallet or using financial services, financial technology, and finally to increase the number of use cases. So if the digital payments can be used for all kinds, to access all kinds of services, usage will increase. When usage increases, also cost decreases. Okay, so I've covered the root causes of the problems and some potential solutions that are aligned with these updated financial inclusion guidance that I want to share the key highlights. So first of all, the Financial Action Task Force, what is it? It's our global financial watchdog. It has 40 members, but all countries in the world are expected to comply with these standards. So the FATF standards are essentially 40 recommendations to prevent serious crimes. So what crimes are we talking about? We're not talking about snow cone vendor on the side of the street who wants to avoid taxes. This is not the kind of crimes we're talking about here. We're talking about money laundering, drug trafficking, human trafficking, corruptions, crimes, serious crimes. We're also talking about terrorist financing and proliferation financing. Another mouthful. What does that mean? It means weapons of mass destruction. So this really came out of 111. The whole world were establishing these, trying to follow these standards to make sure that these crimes are reduced. Now, what's important is that FATF conducts mutual evaluation reviews and rate countries on two things: their technical compliance. So do the country has laws and regulations in place to comply with these standards? And second, are they effective? So essentially, do they impose sanctions to enforce these regulations? And the FATF uses regional bodies across the world to conduct these mutual evaluation reviews, which happen periodically. And in the Caribbean region, we have the Caribbean Financial Action Task Force. The CFATF in the Caribbean is responsible to conduct these mutual evaluation reviews in our region. And we have them with us today, so questions will be open. What's important to mention here is that FATF does not have legal authority, but FATF, if they found that the countries are not implementing the standards effectively, what they can do is they provide a gray list. They put them on a gray list or the black list. And being on these lists essentially has important economic consequences for these countries because it increases their cost of capital, oftentimes reduces the availability of capital because there's less investment, and it can also affect the correspondent banking relationship, which is something, especially in small island developing states, we cannot afford to lose our correspondent banking relationship. So over the years, FATF noticed an overcompliance to its standards, and especially in developing countries. So in June 25, FATF published this new financial inclusion guidance and updated its recommendations. So it says, applying an overly cautious approach to MLCFT safeguards can have unintended consequences of excluding legitimate businesses and consumers from the regulated financial system. And in the past, obviously, they had some sort of interest in financial inclusion in the past, and the risk-based approach has been in the standards for many years. But now, FATF emphasizes that financial exclusion represents a real risk to achieving effective implementation of its standards. So therefore, countries and institutions must address financial exclusion. Financial exclusion not only harms individuals and businesses, but can also represent a real risk to financial integrity by driving activity into unregulated channels. So essentially, what it means is that the cash economy, cash transactions, limits transparencies, undermines the effectiveness of money laundering and financing of tourism safeguards, and increases the risk of crime. I found it quite strange, but in the financial inclusion guidance, you can see examples of many situations where the cash economy has actually led to greater crimes in the society. So how do we reduce financial exclusion? By simplifying customer due diligence through the risk-based approach. And it's important to mention that a risk cannot be eliminated and can only be managed by applying proportionate controls. So proportionate controls to what exactly? Not to their credit risk or things like that. Proportionate controls to the risks that clients, businesses, or individuals engage in: money laundering, financing of tourism, proliferation financing. How many of our MSMEs in the region engage in those activities? Not much. I am sure of that. Now, essentially what it says is if there's a high risk of those crimes, you enhance the controls. If there is low risk of those crimes, you simplify the controls. That's the proportional approach to the risk management process. Now, what are we talking about when we say simplified versus enhanced controls? This is very important to understand. This is where we're going into the meat of the matter. When individuals and MSMEs want to open a standard or business bank account, they must provide information. This identification is a mandatory process called Know Your Customer, KYC. Everybody heard that word, KYC. Some people use KYB for Know Your Business, but essentially it's the same idea. Then the CDD, Customer Due Diligence, involves assessing risk to determine if the information provided must be validated. This is the authentication process, and it should be done only if the MSME is considered a high risk of money laundering and financing of tourism. So depending on the risk assessment, banks can decide what documents are needed to validate the information provided. As mentioned before, in the case of formal MSMEs, banks do not only require up-to-date registration documents, but also detailed financial information that is often difficult to provide for them. Many micro businesses do not have a computer to record their financials. So how could they submit financial statements? These onboarding requirements are not the norm globally and must be changed in developing countries. Micro and small businesses can and should have a business account and use it to record financials, build credit history, and access other digital financial services to grow. The problem is that most financial institutions in developing countries impose enhanced requirements for all MSMEs regardless of risk. Why? Many banks or individuals, businesses blame the regulators. But as Dennis said, we're not here to blame anyone, but in particular, not the regulators in this particular case, because most Caribbean countries do allow the risk-based approach and to facilitate simplified customer due diligence, but most financial institutions are not actually implementing it. I know that some countries have still rule-based approach that needs to be changed, but in general, the risk-based approach has been around for quite a while in the region. Now, Recommendation 10 requires that regulated entities identify their customers. But what the new financial inclusion guidance specifies is that it is essential to distinguish between identifying the customer and verifying the identification. For the identification of individuals and entities, which is mandatory, no identification, documentation, or data is collected. You see the important distinction here. So the verification process is not necessary in low-risk situation. It can be simplified. So FATF standards has no specific requirements regarding the identifiers to be collected, nor how identity should be verified. But oftentimes, these requirements are based not on evidence of risks, but more historical practices that needs to be changed. Many countries and regulated entities take conservative views and define specific items, which should not necessarily be the case. So what FATF is saying, the new financial inclusion guidance is unless these are readily available to unserved and underserved businesses and entities, these requirements may become access barriers, and we want to remove those barriers so that financial transactions are taking place into the regulated financial systems and we don't rely on the cash economy anymore. Now, simplify the customer due diligence in low-risk context. So how do we do that? What does it mean to simplify the customer due diligence? It means that the customer identification, verification, and monitoring requirements, because it's not enough to do this process at the onboarding stage, but banks are required, or financial institutions are required to monitor over the lifetime of the customer relationship. But the requirements, basically the lower risk context, simplified CDD means not collecting specific information, and if so, not collecting supporting documents. Second, a reliance on appropriate assumptions. So we can assume that the businesses has good intention, that the intended usage is basically what they say they will use the businesses for, and that they could also be less detailed and less frequent information. So oftentimes you hear businesses or individuals, oh shoot, I have to do my KYC again, provide the information again. But in the case of low risk context, the frequency of validation should be much less often reduced. So the FATF guidance aims at enabling MSMEs to transact in the regulated financial system. So when opening account, legal entities and such as small businesses with low risk of money laundering and financing of terrorism, the beneficial owners' requirements can also be simplified. So they specifically mention in the guidance that for such customers, minimal information is required. We can rely based on assumptions on information already obtained, and we can also rely on third-party information. Therefore, to open a business account, there should not be any needs of employment letter and financial statements and undertake more in-depth investigation if there are no red flags. So ultimately, in low case scenarios, which is most cases in the Caribbean, I believe, regulated entities may opt to infer beneficial ownership from the customer's declared information without the need for extensive documentation or further verification unless red flags or discrepancies arise. So to simplify requirements, customers must be assessed as low risk. However, of course, so what is the formula for the risk-based approach? How do we assess risk level? So first of all, the extent to which a risk may occur, that's the likelihood. And then we add the likely consequence that these events may produce. And that will give us the high risk, standard risk, or low risk. And then the proportionate approach is that you would impose enhanced customer due diligence if it's high risk, simplified customer due diligence if it's low risk, right? This is quite simple. So when conducting the risk assessment, many factors must be taken into consideration during this risk assessment. So the types of predicate offense, the channels, the type of customers, the types of products and services, the size of business, the number of clients, the importance of business for the financial system, the country, their geographic areas, etc., and the risk of financial exclusion. Now, FATF warns against de-risking. So de-risking means basically refusing to provide a service or terminating or restricting business relationships without necessarily the evidence that this business is conducting is high risk of money laundering and financing of terrorism. And essentially, when a company is high risk, you enhance your customer diligence. You don't de-risk it. You don't say, okay, I'm not serving you. And this is something that needs to change perhaps in the region. In Australia, for example, the financial regulators told their banks that they have to provide a justification, very detailed justification for why they would refuse to service customers, because they recognize that the fintechs are the ones well positioned to serve the last mile, especially in the indigenous communities. The fintechs understand the market, they understand the way the culture works, and they may rely on the written statement of a local chief to facilitate the KYC, right? So doesn't mean the risk of money laundering is higher. It just means you use a different approach and you can justify it. So banks cannot refuse to bank the fintech simply because they're using an innovative approach to KYC. Now, to increase financial inclusion, risk mitigation measures can be implemented. So you've seen I mentioned the formula before. So the risk mitigation measures can be in the form of limiting account balance, transaction volumes or value, limiting the number of customers. So there are certain things that the banks can do initially to build the relationship, and these restrictions can be lower over time. But the point is to reduce the residual risk, because the risk will never be zero. To remove the restriction, FATF recommends using a progressive approach. Also, they emphasize the tiered-based approach. for customer due diligence. And we have the best example in our own region in the Caribbean. And the ACCU, the Monetary Council, approved a change to the Banking Act in December of last year. And that was done after a collaborative effort between the financial institutions and the regulators for more than a year. And basically, this enables MSMEs to enter the financial system and build a business relationship with the banks. And over time, the restrictions may be lifted because banks may realize that these businesses are not doing any unusual activities or no red flags have been identified. But essentially, the business in the ECCU can open a business account with one identification, and the account must be free, does not attract charges, accrues interest, and has no minimum balance requirement. So this is a fantastic progress that has been taking place in the ACCU, and I don't understand why we cannot have this level of progress in other Caribbean countries as well. And here I have another example taken from Trinidad and Tobago that I like, the tiered base approach. For a certain level of, this is an example for mobile wallet onboarding requirements, but my point is just to say that for small amounts, no identification is required whatsoever. When you want to transact with a little bit more amount, then larger wallet size, then you would provide one valid identity. And for larger value size, then you would need to provide, for example, a proof of address, and then regulators will say what can be used as a proof of address in this particular context. But regulators so essentially across the region must do more to stimulate adoption of the simplified measures among the banks. They can, not necessarily by enforcing particularly, but by supporting the identification of low-risk areas. They can communicate this information to the regulated entities and encourage to apply simplified measures for businesses that operate in these low-risk scenarios. The countries can also provide guidance and information on the approaches that can be used to implement the simplified measures where risks are lower. But at the same time, financial institutions can establish their own risk-based approach. But this implementing the risk-based approach can be highly expensive because we have to change the way we have been conducting business for years and years. So manuals has to be changed, procedures have to be changed to implement the RBA for institutions that have not yet done so. Collaboration makes sense because it can reduce the cost. Because the first thing that requires that it needs to be done is to assess the money laundering and terrorist financing risks. And that requires a national risk assessment, an institutional risk assessment, and a sectorial risk assessment. So when these risk assessments can be done collaboratively with the support perhaps of development agencies, could be great to identify. For example, we could identify all pepper sauce manufacturing companies in the Caribbean regions are low risk of money laundering. Therefore, if you're a pepper sauce business, you can automatically get a business account. Why can this not be happening? I've seen this kind of examples in other countries. Now, the second thing is to implement the controls to manage, monitor, and mitigate the risks. That is where we need to invest in fintech in reg tech. We have a lot of work to do in the financial services sector of the region to integrate the information among the different systems that are used. And RegTech is an easy solution because the RegTech companies' technology is available and can be implemented. And then finally, and I'll stop here, Dennis, to simplify the onboarding requirements for low-risk customers and promote usage. I have seen some financial institutions in the region doing amazing progress, but they also struggle to get the businesses understand what they need to do. So education campaigns are critical, financial literacy is critical, and that is also when we need to partner with development organizations to support this effort that the banks are doing. I will stop here and happy to answer any questions you may have. Thank you.
Thank you so much, Annie. As you can all tell, this is a very deep topic, but on the face of it, there's a few things I just want to highlight before we move on. That 70% leakage from our tourism revenue due to exclusion is a jarring number. I mean, if we are able to address this issue with policy, we can have an immediate and dramatic impact on our economy. I'll just first say that as a comment from what I saw there. And if I heard you correctly, implementing a risk-based kind of approach to due diligence means that the coconut vendor in Barbados and the small tour operator here in Dominica does not need a stack of documents to open an account. Now, that's what I thought I heard you saying, and now I think I'll save some of your comments for the discussion at the end. But we also have here a lot of the compliance professionals might be saying, this all sounds great, Annie, but what are the regulators saying? And to answer that today, we're really pleased to have with us the region's regulatory voice. So please welcome right now Ms. Alison McIntyre, the financial advisor at the Caribbean Financial Action Task Force, that's CFATF. So Alison, first of all, if you want to add any contradict or you want to add any color to what anything that Annie has said, you can feel free to do that most definitely. But also please do set the stage with regards to what CFATF is, what your institution does, and why is it relevant to all of the people on this call and even to the public at this time.
Good afternoon to everyone. Thank you, Dennis. So the Caribbean Financial Action Task Force is one of the 9 FATF-style regional bodies. We do more or less the same work that the FATF does, but we do it for the Caribbean region. We currently have 24 member states, and last year in December, we added another member state, which is the USA. So we conduct mutual evaluations. It was mentioned earlier in Annie's presentation, and the mutual evaluations that we conduct are really and truly to assess countries' systems that they have in place to fight financial crime. Annie would have also mentioned technical compliance is assessed, and we look at countries' legislative systems, whether or not they have the appropriate laws and enforceable means in place to deal with the risk, to address the risk or the financial risk that they face in their domestic situation. And just to clarify that effectiveness is really not an assessment of whether or not countries are implementing sanctions only. It's only part of effectiveness. Effectiveness really looks at whether or not countries understand their MLTF risk and their PF risk. It looks at whether or not countries are cooperating domestically and internationally to put themselves in the best place to mitigate their financial risk. And it also looks at resource allocation. It looks at training for staff that has to do the work. It's a lot more than implementing sanctions for non-compliance. So that's basically the CFATF and what we do in a nutshell. Why are we important to the persons on the call? If we have regulators on the call, they would want to know who we are and what we do. If we have financial institutions, if we have what we call DNFBPs, designated non-financial businesses and professionals, they will want to know who we are and what we do. So basically, the 40 recommendations that Annie would have mentioned before are more or less a roadmap that countries can use to develop their legislative systems, and the 11 immediate outcomes, which are various areas that we assess in terms of practical implementation of the FATF methodology or the FATF standards. They provide a roadmap of standard operating procedures that countries should have in place to make sure that along with the laws, we are also doing what we need to do that according to our risk and context to mitigate our financial crime. So we use what we call the FATF, the FATF methodology, and it is a combination of the 40 recommendations as well as the 11 immediate outcomes. And of course, the CFATF, we don't do this in a silo. We recruit assessors from around the Caribbean, and these assessors volunteer to conduct these mutual evaluations. The mutual evaluations are a peer assessment, a peer review. So your peers, the people who do the same work that you do in other jurisdictions, will come to your country. They will look at what you're doing. They will look at your laws. They will highlight any deficiencies that you may have and give recommendations about how to improve them. They will also look at the things that you are doing well and give credit there to say whether you're doing well in this situation and you need to continue doing well in this situation because you are really and truly effectively mitigating financial crime with the work that you're doing.
Thank you so much, Alison. One of the things that you mentioned, MLTF, that's money laundering and terrorism financing, correct? So in which ways do then this exclusion exacerbate that very problem that I guess the regulatory frameworks that we had before were designed to to help to solve. That's just one thing. And secondly, I'll just ask, in your experience in the region, do you think that most Caribbean countries already have the regulations that support simplified customer due diligence for low-risk MSMEs?
So I'll answer the second question first. The answer is yes. So just today, before I came on, I looked at a comparison tool, and only all of the countries in the Caribbean have legislation that allows for simplified due diligence. And we want to remember that the FATF recommendations and legislation are usually drafted in a very broad sense. So you would find that these documents would not tell you exactly how to conduct simplified due diligence. And of course, simplified due diligence, the application of it is based on risk. And the legislation that we have throughout the region has always, and when I say always, looking at the fourth round assessment, the fourth round of mutual evaluations in the Caribbean, the countries have always had legislation to allow for simplified due diligence. There are about 3 jurisdictions that had some sort of restrictive legislation in place saying that the simplified due diligence will not apply in certain instances. And of course, those situations are justified because the risk has not been identified as low, and therefore simplified due diligence cannot apply in these situations.
Annie, would you want to just jump right in? You had a very relevant question that you had just sent me. I wonder if you would pose that to Alison, please.
Yes, sure. Hi, Alison. I was just wondering, I was looking at the chat also, and you're just saying right now that the legislation enables simplified customer due diligence, and confirming what I also said, but then the financial institutions are not implementing it, stating that the regulators are preventing them from simplifying the due diligence oftentimes. So there were some entrepreneurs in the chat asking, like, so what do they do if the banks are refusing to bank them? What should they do?
Okay, so that is not something the CFATF would deal with directly, because we cannot tell jurisdictions what to do. We cannot tell a regulator exactly what to do, and we certainly cannot tell a financial institution what to do. The legislation has been there. If we look at the fourth round methodology, we will see clearly in criterion 1.8 that simplified due diligence can be allowed, and based on the assessments, it has been incorporated in the legislation of all of the jurisdictions in the Caribbean. If at a domestic level, banks and regulators are choosing not to do simplified due diligence, the CFATF cannot force them to do that. What has happened is that the FATF has noticed that although it is there, it is not being used. And so the recommendations have been changed, the language has been changed. So now, apart from the fourth round methodology, we now have the fifth round methodology going forward. And the fifth round methodology, if we look at criterion 1.9, we see where the language has changed to say that countries should allow and encourage simplified measures. In the Caribbean, we need to ask ourselves, have we become risk averse? It has always been there. We have chosen not to use it. Why have we chosen not to use it? So we need to look at ourselves and ask ourselves whether we are risk averse. Is it that we've become a culture of people who do not want to take on risk?
And that goes back to what Dennis was asking, the question about financial exclusion. So how will CFATF assess the risk of financial exclusion to the risk of money laundering and financing of terrorism going forward in the fifth evaluation? How will financial exclusion be looked at?
So financial exclusion risk, some countries don't even know what their financial exclusion population is and why they're financially excluded. So what we will be doing going forward is really looking at the real risk. Who are the financially excluded people? What are the financial vulnerabilities they are facing? And we want to look at financial exclusion risk individually, separate and apart from broader MLTF and PF risk. So we want to zone in there and see, because most economies, most countries have a shadow economy, they have an underground economy, they have an informal economy. Why do we have these? On one hand, yes, we know that criminals want to exploit that. And on the other hand, we know that financially vulnerable people are forced into it. Financial inclusion is opening a gateway where financially vulnerable people are not forced into shadow economies. So when we look at a shadow economy, we can say, okay, this is a criminal stomping ground. But as we speak now, we know that there are people who cannot afford to open a bank account because of the fees. And that is not exclusively an AML-CFT issue. There are some people who don't have bank accounts because they've been de-risked, which is absolutely opposite to a risk-based approach. De-risking someone is the exact opposite to applying a risk-based approach. Because even if a customer's risk is high, your measures should mitigate the risk, not eliminate, and that's another thing. We have taken a zero tolerance approach. That is not what legislation is requiring, and that is not what the FATF recommendations are requiring. Not that we have a zero tolerance approach. Okay, you cannot provide information about your address, you will never have a bank account. That's a zero tolerance approach. And nowhere in the recommendations or in the methodology it's suggesting that. And I think because it's been misinterpreted, the FATF has chosen to expand the financial inclusion guidance. And if you look at the guidance, you will see examples at the end in the annexes where countries give information on their different strategies they've taken, strategies on creating suitable bank accounts for financially vulnerable people that address the 5 key points that you'd have mentioned earlier, accessible, affordable, and all that sort of thing. So financial inclusion now is not just about access, as you would have mentioned earlier. It is about the ongoing use of the account. It is about financial literacy. It is about expanding your financial portfolio, even though you may be of lower income, you may have a small business. Access to a broad range of financial services is the key here. And going back to the question, the risk of financial exclusion will be looked at separate and apart from the broader MLTF risk. And that is how it will be assessed going forward in the 5th round.
This is such valuable context. I'm going to ask Melissa, and we're going to organically transition to this more broad discussion as we add to the discussion Ms. McIntyre. But I will comment as Melissa does that there is as well, I suppose, the business case to be made. You talked about the amount of money that is in the informal, untaxed, if you're a revenue officer in any government, again, untaxed economy as well. So that represents revenue for your jurisdiction that you're not realizing. It presents, if you are a enforcement officer in terms of the law, that it presents a dark part of your economy that is an additional risk as well. And then if you are somebody who's an advocate for small business, again, that reduces their chances of accessing things like loans and the kinds of information that will help to really expand and grow their business and to grow their economies. We already talked about the leaky bucket that we have with the 70% of leakage that we have in tourism. But to make that a little bit more concrete, now we've heard from our great Annie Bertrand as an advocate for inclusion, and Ms. McIntyre, again, with regards to the regulator's perspective. We want to take this to make it very practical. So I'm pleased to welcome Lucinda James Williams, the country head for CIBC Caribbean and Antigua. Lucinda, thank you for joining us. I ask you as we get started is to comment, first of all, on what you've heard, of course, but given that about 75% of MSMEs do not have a business account, and most of their transactions are conducted in cash in the Caribbean. Do you see any value for banks to adopt simplified customer due diligence? In other words, do you see a business case for banks like CIBC Caribbean? And as well, what are some of the impediments and challenges that you'll face when trying to get there.
Thanks, Dennis. I have to apologize for keeping my video off. I'm having bandwidth issues. So when I turn my camera on, it kicks me off. Very happy to be here. I do want to say right off the bat that banking is a service industry. We serve clients, we serve individuals, MSMEs, large corporates, sovereign government. We're not trying to exclude anyone from the formal financial sector. It is good business to have more clients. So there's no need to do a business case. The more clients you have, the more money you can make. And I think there is also a misconception, or perhaps we've been using a broad brush in the discussion so far as it relates to simplified due diligence. We do have banks that have very robust RBA programs that do simplify due diligence, that have your low risk customers, medium risk customers, high risk customers, and these customers are treated differently proportionate to the risk. In terms of the broad brush as well, I realize the discussion hasn't mentioned the fact that quite a bit of work has been done, especially in the ECCU region, to come up with the ECCU First Step Basic account that covers quite a bit of what we discussed already. And this was a collaborative effort between the banks, ECCU Bankers Association, and our regulator, ECCB. The account was launched in, I would say the last country came on board April 2025. So it is fairly new and will take some time for us as banks to continue the education, the engagement with the public. But that is the first account where the simplified due diligence is applied very simply. It is one piece of ID, and this is both personal as well as business customers. I would say the big criteria, if you wish, is that the turnover should not exceed 36,000. I know the entrepreneurs on the call will say it's too low, but we needed a start. With that account, it's access with debit card, online banking, access to the point of sale machines, online domestic transfers right across the ECCU. So that's 8 territories. There is an exclusion in terms of international wires. And again, we just needed a start.
Yes.
Once we're able to continue to onboard customers, both personal and your MSMEs, once we get more comfortable, we'll be able to review and expand, I would say, some of the parameters. So just really wanted to put on the table immediately that this account is already available and that banks are already utilizing some measure of simplified due diligence, as well as the fact that we do have banks that apply RBA. I agree that we don't have full utilization, and that is something, again, that the banks are working on. And of course, Annie did go through, I would say Annie did a very good job in terms of highlighting some of the current issues, but this is a topic that is top of mind for all banks. And it's not only in terms of a social impact, it's not only because we want to work with our regulators. It's the fact that from a business case perspective, you're looking at really broadening your customer base, being able to increase your deposit portfolio If you increase your deposit portfolio, it means you have more to lend. All big entities started small, and the potential for loans, the potential for transactional fees is quite significant. So we see it again, not just in terms of the social good, which there are plenty, but from a financial standpoint, it makes good business to do more business.
Absolutely, and I want to repeat that again. You just heard a banker say this is actually some. First of all, I think we all need to applaud the progress that we are already making. There's too often that we look at how far we have to go without looking at how far we have come. And just this past April, as Ms. James Williams has mentioned, there are these basic accounts. Now, and I'll pose this to you, Ms. James Williams, and then we're going to ask the rest of the panelists to start to chime in. And Melissa, I will also ask you to feel free if you have some interesting comments or questions in the chat as we start to get through our last 20 minutes or so, that you can jump in with some of these. But let us, first of all, I'm going to ask you, Ms. James Williams, what sort, if you had a wish, if we were to come back here in 1 year's time, what changes do we need to see? And what sort of help do the banks as well need? I think that we do not stand alone in this ecosystem. We are a connected ecosystem, so we all have roles to play in solving this issue. I know that we are all, for the most part, Caribbean people here, and we have a vested interest in it working well. But what sort of changes and support would you want to see happen over the intervening year from now until December of 2026 that would help us to understand that we're making progress? Is it harmonized legislation? Is it support in other ways? Is it new software? What is it that we need to do?
I would say from the ECCU bankers' perspective, it's engagement. So it's like the biggest secret. And having this, and I want to applaud you for this engagement, but having more of these types of engagement, discussions with the various chambers, joining with the Bankers Association just to spread the word, having the discussion with the government so that people are aware. Because the uptake, surprisingly, hasn't been what we were anticipating. And it could be simply a matter that people are not aware that this account is available. So helping us spread the word and speaking directly to the individuals would be a big help for us. Secondly, I would say there are banks that do require assistance where the RBA implementation is concerned. A lot of them have outdated legacy banking systems, and the cost is quite prohibitive to change your entire core banking system. And so any sorts of, I would say, technical support in terms of how to address this issue would be keen, as well as the compliance officers require upskilling. So from a technical support standpoint, really assisting our compliance officers so they too understand how to do the risk assessments. Also assisting, I know I'm going on, but
No, this is great. I see
also,
Annie taking notes as you speak and nodding her head. So this is actually what we need. And I'm going to ask Annie after you're done with that list, what parts of that can the CDFA start to help with as well? So please do continue that wish list.
Perfect. So technology we spoke about, but the people piece for me is also quite significant. Data quality remains an issue as well. So we again do need to continue the training of the MSMEs in terms of just simple bookkeeping, how do they do their records, making them more ready, I would say, for the formal financial sector. And I would say in terms of the proof is in the pudding. So changes have been made. There is still some apprehension on the part of banks as it relates to the reviews. We have not had a series of the FIUs and the regulator doing a review with the new guidelines. So I think people are anxious to see when they do land what the results would be for the on-site examinations.
Right.
So we just have to make sure we're all on the same page. And when the on-site examination does occur,
There's no
we're not
surprises
brought
there.
back. Yes, please. Yes, please. And
Yes.
finally, periodic client reviews. And we spoke about it. You do your review, you get your score, transaction monitoring continues, but also your periodic client reviews and understanding the client through the life cycle is a daily requirement. I do think we need some better tools to aid with the periodic client reviews, whether it's AI based, but just so that we can get the data points and the information we need from our clients to make the periodic client reviews a bit easier.
Very good. Before I ask Annie to comment on that wish list, I made the mistake the last time of leaving audience questions to a little bit too late. So I want to turn to Melissa Boutin, who's one of our colleagues on the executive committee of the CDFA. Melissa, do you have anything that you have gleaned from the chat that you want to put to the panelists, or comments that we want to surface up for everybody to hear?
Yes, first I will start with my own question, and then I'll add after that one from Jarion. But my question is in terms of the customer onboarding. Ms. Williams was speaking about some of the challenges that banks have, and she even spoke about the perspective of the ECCU Bankers Association. I haven't heard you did touch on technology of having legacy core banking systems, but I haven't heard about how banks are using technology to help with the risk-based assessments, and that would ultimately help customers. Secondly, as a banking customer myself, a returning national to St. Kitts and Nevis, in terms of providing documentation, many are able to provide it, but the rules keep changing as well. More recently, what I have seen is that, of course, as Caribbean people, we live in multi-generational household. It's a very wide practice. And even if you have a lease where you're renting, now banks are asking you to provide the ID of the landlord. And anyone here on the panel who is aware, is that part of the legislation to ask for a third party's ID to prove where you live when you already provided a lease? So I guess my question is twofold. One, does technology come in for the banks to help with the risk-based assessment? And number two, we as the customers who are banking, who jump through the hoops that are there for us, even after we jump through it and we want to open another account at our existing bank, we are asked now with a new rule to provide a third party's ID.
I want to jump on the one because I actually have an answer for one. I joined the CDFA as a technologist, not somebody who's a financial compliance expert, and I will say, and do reach out to us, because through the CDFA and my work at the DX Alliance, I happen to know that we have a number of excellent financial technology professionals throughout the region and in the diaspora who can assist banks with exactly that sort of a thing. So the expertise is here, and I hope that we are able to provide some of that support. I wanted to get on that because I only have one that I could really answer for anybody. And then the ones that Melissa has stated, again, after jumping through those hoops and then having to provide things like third-party IDs and so forth to any of the panelists, what do you say about that? What do we do about that? And is that the right thing to do? Or how do we deal with that sort of situation?
Let me answer Melissa's question this way. I got a call, Melissa, on Friday, a client saying, Vidisa, I need an appointment to open an account. And I said, appointment? Just use the app. And she called me Monday, excited to say she got her account. So digital client onboarding is already possible. It's been possible for several years. And I think it is the same difference, Melissa, in terms of some banks have RBA, some banks don't. Some banks have digital client onboarding. Digital client onboarding for CIBC was made possible because we have RBA approach. If you need a new account, you could do it online. If you need an additional account, you do it online. You pay your bills. Like, I work at a bank. I do nothing at a bank. I do everything with my app. There is nothing that a customer of JP Morgan in the States, there's nothing they can do that we can't do. So it's dependent on the bank that you've utilized. In terms of, there was another question you were referring to, asking for the ID of, it sounds to me as though that bank does not utilize a risk-based assessment, and so they're using high risk assessment for everyone. That is a specific to an FI, and when the on-site examination happens with the regulator, I think they'll be reviewed negatively.
Yeah.
To clarify, Ms. Williams, when it comes to CIBC, there's no digital onboarding for MSMEs, because I did approach CIBC looking for business banking. So can I clarify that?
Yes, there is what we call digital client onboarding for sole traders. We are working on the tool for partnership, and we have digital client onboarding now for corporate. So in fact, the one grouping that isn't yet finalized, but it's coming, would be your partnership.
Right on. And I happen to know as well that certain of our colleagues in the ecosystem at other banks are also have some solutions that are in the works in this area. I'd like to, Melissa, you had one from the audience. I'd like you to ask that. And then what we're going to do is just to go around the room for some closing remarks. Ms. McIntyre, if you'd like to make some as well, Ms. Osborne, and then Annie, we'll wrap up with perhaps some of that wish list that we had heard before I close it out. So Melissa, pose that question. I'll let anybody answer that, and I'd love each of our panelists, and of course Ms. Osborne as well, if you have any closing remarks before we wrap in the last 5 minutes.
Okay, first, thank you, Ms. Williams, for providing the answer. I appreciate that. I have, I guess, a two-part question from Jarian. He said, how do we bridge the gap and invite conversation and understanding, specifically for entrepreneurs building financial services and technology for the region? And how can the advancement of the ECCU be transferred to countries like Trinidad and Tobago, Jamaica, etc.?
Wonderful. Thank you so much. Any of my panelists, Ms. McIntyre, I don't know if you wanted to speak to that, and then we can pass it along the chain, wrapping up with Annie and then myself.
So I can answer the second question. Last week at our plenary in Barbados, the ECCB did in fact make a presentation on their financial inclusion product. They went into detail about the type of activity they would have conducted before developing and launching the product. And all of the member states of the CFATF were there. So everyone is now aware of what the ECCB has done and how they did it, to the point where we had the delegate from the USA commending the ECCB on the work that they did. And basically, the information is out there. The different central banks around the Caribbean are now aware that it can be done. They have an idea of how to do it. And the ECCB has opened themselves to help and assist any other central bank in the Caribbean to launching similar types of products. It's an excellent product. I know Ms. James Williams would have spoken about it, but there are other excellent attributes to the account that it accrues. It does accrue interest. There's no minimum balance fee and all that sort of thing. So the information is there. The CFATF members are aware that it exists, and the ECCB and the other central banks are willing to collaborate and expand this type of product throughout the Caribbean to enhance financial inclusion.
Wonderful. Ms. James Williams, do you have any comment on that or closing remarks before we get going?
Just to say again, more business is good business. So we are all on the same page. The same team, same page. We live in the community. MSMEs are our family or friends. So there is no us versus you. The more that we can attract, the more MSMEs that we can attract, it's the better for all of us. So we're very happy in terms of where we are, and we really look forward to continuing to expand.
I think the being all on the same team is a great segue to ask as well for a closing comment from the OAS, because after all, at the end of the day, you so rightly mentioned it, so many of these MSMEs and micro people are fathers, mothers, uncles that made us what we are today. And everybody from the people in the bank to the folks and the regulators are on the team to solve this very complex issue. I love sports. I know that as I watch sports, everybody knows what to do when you're sitting in your armchair. And when you get the job to be the coach, it's not so easy, and you have to work together to make success. Ms. Osborne, in terms of that all on the same team, why don't you give us your closing comments before I pass over to Annie, and then we'll show some information about how people can get in touch with the CDFA.
Thank you. Thank you so much. I think that was such a rich discussion, and I hope that we can do more of it. And we are indeed all on the same team, right? We've been working arduously at the OAS over the past few years, particularly as it relates to women and women-owned and women-led MSMEs, as they are usually the ones that are left out of the formal financial ecosystem. So there's a lot more to do. I really do believe, I believe Ms. McIntyre mentioned whether we are risk averse. I think there's some element of that. I think sometimes we can over-regulate, if you will, or people are so threatened by the regulations that exist, or they don't know. And we've been trying as OAS to do some work on MSME formalization, because we realize that people just don't know what they don't know. So that we really want to get our MSMEs into the formal space. We want to point them in the right direction. We really urge those who are operating on the ground to reach out to them to perhaps do a little bit more in country to encourage their participation, their engagement, their formalization, make the processes as easy as possible. But we remain committed to working with MSMEs and the institutions that serve MSMEs as an organization, because after all, we know the entire region. The region is built on MSMEs, and 95% of the businesses in the Americas are MSMEs, and in the Caribbean it's even higher. So we really want to ensure that they have access. Our work is not done, and we rely, nothing we do at the OAS is done alone. We rely very heavily on partners. We're always willing and ready to partner with you. And so feel free to reach out to us, as we will with you, to continue the discussion, to continue the dialogue. We want dialogue, but as I always say, dialogue without action is meaningless. So let's move. Let's not continue the same statistic that so many people are outside of formal financial ecosystem. Let us work towards action so that we can bring more people into the fold. So thank you again for taking the time. Really appreciate, Dennis. I noticed that you're from Dominica, and I am from Dominica.
Wonderful, second that. Oh, that's wonderful. Yes. So as I would have said in my previous life, faith without works is dead. So we have the belief that we can do it, but we also need to put some actions to work. Annie, I was going to close, but I'm showing the screen here about the CDFA, and I saw you were taking some notes. Why don't you wrap us up with what the CDFA is going to be able to do to assist in this process, and then we'll just call it a day.
Okay, thank you, Dennis. Yeah, I'm on, is that right? No, okay. So one thing that I noticed, like, for example, like Lisa mentioned that, like, we did some broad brushing, right? Then this is absolutely true. We did that. But one thing also she mentioned that I thought was interesting is that she said even like banks compliance officers need training. A lot of them are not up to date with this kind of financial inclusion guidance. So in some banks that is the case. In some other banks, the compliance officers are highly well skilled in this space, but then they have implemented a robust risk-based approach to improve access to services. But then the regulators in that particular country would come and say, no, you need to have collected this information. And they say, no, we're supposed to have implemented. But then the regulators in the financial authority may need training. And in some other circumstances, I had discussion with CEOs of banks, and it's at that level where they say, no, this is the way we have to do it because of the International Financial Action Task Force. And in some other cases, it could be the pressure, it comes from the correspondent banks. But every case is different. In every situation, every example I mentioned, training and collaboration is required to share knowledge and to transfer knowledge so that change can happen. And that's why I'm super happy that Secretary Osborne was with us today. And not only that, the OS has been supporting this effort, but also inviting all the representatives across all the Caribbean regions. So now we have more people understand the problem. So if we have more support to facilitate collaboration among the financial regulators, among the financial institutions, and across the region, we will build greater harmonization as well for creating these economies of scale that we need to do in order to reduce the cost. So the CDFA, essentially the Caribbean Digital Finance Alliance, was established precisely to increase access to digital financial services across the board in the region. So hopefully with this kind of dialogues, we can make a difference and we can continue to engage in the future. So I'll stop here.
Wonderful.
Dennis.
Thank you so much, everybody, for joining us. We really appreciate all of the collaboration and engagement that we've had with each of you. You can see right there on the screen, if you want to be part of that solution, if you want to continue this collaboration the other 364 days of the year, scan the QR code or go to caribbeandigitalfinance.org/membership. You can also reach us by email at cdfa@caribbeandigitalfinance.org. And we'll be happy to have you. We're in a soft launch mode right now, but as we get going, we need more hands at the wheel because there's much work to be done, and it's all of our jobs. So I want to thank each and every one of our panelists for joining us today, and each of you in the audience as well, and my colleague Melissa Boutin as well for helping with the chat and all of the administration. Thank you so much. Go forth, have a great day, prosper, and let's keep showing up for each other.
Go SMEs.
Global standards, island agility, and Caribbean unity. We are the CDFA.